Thank you, Peter, and welcome everyone. My name is Ron Shamgar. I'm the head of Australian equities at Tamim Asset Management. Today, I'll just give a brief presentation about sort of our investment style, what we look at, especially in the small cap space. And then I'll talk about a handful of companies that we like and that sort of fit that criteria. So just quickly about Tamim, we sort of offer wholesale investors Aussie equities exposure through two funds that I manage. We also have an international equities fund, and we also offer some property and a credit fund as well. So just to start with our investment philosophy, we're really looking to identify companies that fit a fundamental-based investment process. We're looking for long-term capital growth, targeting companies that are, have strong financial capabilities, profitable, growing earnings, generating good cash flows. And we're also looking for industry tailwinds as well. I've been with Tamim for just under 4 years. I manage two funds, the Australian All Cap Fund. Since I joined, that fund has delivered just under 15% per annum net of fees. And then there's another fund, which is the Small Cap Income Fund. And that one has delivered almost 16% per annum after fees as well. And I've been doing this for about 20 years. And I have a saying where, we watch like a hawk and we pounce as a mongoose. Basically, what we mean is, we sort of look at our universe of stocks and we always meet management teams trying to understand these businesses. And when there's an opportunity, we're quite nimble compared to some of the bigger funds with billions of dollars under management. And we're able to move quite quickly and invest in companies and hence outperform the market. So what kind of companies are we looking for? So our kind of business, as we refer to it, is businesses that have revenue visibility. So we're looking for companies that either have recurring transactional revenue or potentially contracted revenue. So every morning they know exactly how much they're going to make in the next 6 to 12 months. Looking for businesses that convert those earnings into cash flow. And we're looking for businesses that generate free cash flow, so low capex intensive businesses. Conservative balance sheets is always a preference. We don't mind debt as long as the earnings can cover the debt and the interest payments quite comfortably. And in these times of high inflation and competitiveness, we're looking for businesses with pricing power, which really is essentially the best hedge against inflation as well. And we'll talk about some businesses that actually are benefiting in this inflation environment. And most importantly, and especially in that small cap part of the market, we're looking for management teams with a good track record and that are aligned to shareholders, meaning they actually own shares in the business. And we'll talk about a few of those with large shareholding by the management teams. Big picture, I think you really want to understand what is driving revenue and profits in the businesses you invest in, and really understand the industry tailwinds and not fall for some of those value traps out there that look cheap, but they're actually in structural decline because of disruption to their industry. And then once we tick all those boxes, we want to really know what's our upside. So we're trying to identify catalysts for what's going to re-rate the share price, what's going to make other investors buy the stock. And then, we try and model out the business, try and understand what it's going to earn in the next 2 years. And then we want to buy it at a large discount to what we think it's worth. When it comes to valuations, we have a saying that we would rather be approximately right than precisely wrong. And pretty much, if a business is worth $1, I don't think it matters too much if you got the valuation by plus or minus 10% if you're buying it at 50 or 60 cents in the dollar. And that's really the key. The first business we'll talk about is a company called DGL Group. They only listed about a year and a half ago. They're about a 450 mil market cap. They provide chemical logistics, formulation, and warehousing services in Australia and New Zealand. What we like, it's a founder-led business. So the managing director owns 55% of the group and has been buying shares on market since listing as well. They have an acquisitive track record, so they do buy companies and they're building out a national footprint to service larger clients in Australia and New Zealand. They built a really strong competitive moat through various property and land assets for these chemical formulation and warehousing and disposal services that they provide. And they have various licenses that do have quite a bit of a moat for other competitors to enter the market. There is a bit of a European energy crisis going on, as we're all aware of, and a lot of these manufacturers for some of their key chemicals that DGL imports, they're actually shutting down their manufacturing in Europe. The managing director had the foresight to build up its inventory in anticipation of this, and we believe that that will give him an edge against some of the local competitors as some of these shortages of some of these key input ingredients happen in the next 12 months. So we think they'll be a beneficiary. Last year, they did 370 mil revenue, 66 mil EBITDA. They own $150 million of property as well. We think it's worth about double. And the key catalyst here is the AGM guidance. I think the market might be surprised and might have a much better year than what's expected. And they will continue to do acquisitions as well. And so this is another business that we like. Next one is a company called Earlypay. They're about 135 mil market cap. So they're really the second largest non-bank invoice funder and equipment finance provider in Australia to small businesses. Last year, they invoice funded $2.5 billion, and they're run rating close to $3 billion this financial year. They've got a $100 million loan book as well. Because this invoice funding is insured for the majority of the invoice amount, they've had negligible default over the years, a really great long history of profit growth and consistent dividends, as you can see from the bar charts. And last year, they really reached an inflection point. They reached a significant scale, which lowered their funding costs and has enabled them to onboard larger customers as well. They were a takeover target just before COVID. That fell through, but we believe that they're still a takeover target, quite an attractive business for some of their key competitors. They are an inflation beneficiary, so because they keep a small margin, a small percentage on each invoice that they fund, as we have inflation and businesses raise their prices, they just make more money, simple as that. They're trading on about 8 times PE multiple, 10% gross dividend yield, and we think they're worth about 60% more where they are now. And the key catalyst, I think, will be the guidance for this year at the AGM. Next business is a company called People In, about a 340 mil market cap. They're one of the leading ASX-listed talent solutions businesses, so provide recruitment services. Again, a founder-led business and has had quite an amazing, consistent growth since listing about 7 years ago, as you can see on the bar charts on the right side. They do have an history of M&A. They do acquire businesses and integrate them really well. And they have a balance sheet that can support about $30 million of further acquisitions. They're quite diversified in terms of a geographic and sector diversification in Australia. They exposed to the nursing and health market, IT, technology, accounting, and they're also in industrial, agricultural as well. They are a big wage inflation beneficiary. Again, they earn a small margin percentage on the wages that their staff earn. And so as we get in this wage inflation coming through, they're just going to make a bit more money as well. We're seeing job vacancies at all-time high, and with the borders reopening, and getting that increased sort of immigration of skilled labor, that will only provide good tailwinds for this company. Really attractive valuation. They had a really strong FY22, and they're guiding for a strong growth again in FY23. We're looking at about 40% EBITDA growth. They're trading on about 9 times PE, and they also pay a good dividend yield as well. So the key here is the guidance at the AGM and further acquisitions. Finally, we'll talk about a company called Clearview Wealth. They're about a $450 million market cap business. They're the leading mid-tier life insurance provider in Australia. They got approximately 7% market share. The life insurance industry, following a lot of these structural reforms that happened over the last few years, has really improved. And the industry in total has actually turned very profitable. They have a very strong balance sheet, which is quite attractive. They have 74 cents in asset backing in terms of cash and investments. They're currently trading at about 60 cents. And the embedded value, the EV, which is essentially all the life insurance policies that they've sold, if you were just to discount that future cash flows from those policies, that's worth about 92 cents a share. So again, a large discount to its asset backing. Now, the industry has consolidated significantly over the years, as can be seen from that image. Pretty much the banks have exited, and Clearview is really one of the last remaining sort of independent strategic players. Average multiples for acquisitions has occurred at around 1.1 times EV, so potentially about $1 a share. And the key catalyst here is really the largest shareholder, which owns about 50%, is Crescent Private Equity. They're looking to exit that investment, and they've initiated a strategic review back in the beginning of the year. And we've expected an outcome or a takeover to happen by this August results. The company said that the strategic review will continue, but there's still interested buyers out there. And we think something will happen probably by the end of this year. The good thing with Clearview is that they're a big beneficiary of rate rises. So every time the RBA in Australia raises rates by 1%, it adds about $2.5 million to their profit before tax. And that's quite material for a business that reported $28 million of profit last year. So, I think that the key catalyst here is really the strategic review coming to an outcome, and we think possibly a takeover. And I think regardless, the company will continue to grow, and it's probably trading on about 12 or 13 times P multiple, and it pays about a 3% dividend yield as well. So these are the kind of businesses that we look at, and we think a lot of these will benefit in that high inflationary, high interest rate environment. Finally, this is just a quick snapshot of the Australian Small Income Fund that I manage. And as you can see, had a really good, strong return since inception over the last almost 4 years of 15% per annum. And if you want a copy of the presentation, you can email us or you can contact us as well. Appreciate the opportunity to present to you. Thank you very much.